Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Newmont wants Barrick Mining to improve operations before spinning off assets into a publicly traded company. According to Bloomberg, Newmont believes it has the power to potentially block the IPO. Barrick announced last week that it plans to spin off its North American gold assets, which will include interests in the Dominican Republic, as well as its flagship Nevada joint venture with Newmont. Newmont has been ramping up pressure on Barrick after a string of operational setbacks. Clothing retailer Eddie Bauer has filed for bankruptcy with plans to sell as many of its stores across Canada and in the U.S. as possible and liquidate the rest. The bricks and mortar chain listed more than $1 billion in debt, and the move marks the third time the company has filed for bankruptcy. Eddie Bauer's e-commerce and wholesale operations, as well as its retail stores outside of North America, will not be affected by the wind down. Shares of Novo Nordisk are moving higher today, about 3.9% right now, while shares of Hims and Hers Health are tanking. Novo has sued the U.S. telehealth firm over patent infringement after it launched a cheaper copy of Novo's weight loss pill, Wegovy. Novo is seeking damages for what it describes as reasonable royalties and lost profit. The move follows a warning from the U.S. Food and Drug Administration, which signaled a broader crackdown on compounded GLP-1 weight loss drugs. And taking a look at the TSX, continues that bounce back. It's up 0.9% right now, pushing back toward record territory, still below 33,000 though right now. And heading over to the U.S. markets, quick peek down there, and they're bouncing back as well after a roller coaster week last week. Everybody's solidly pretty much in the green. You can see the S&P 500 pushing 7,000. It's up a half point. The Dow Jones up slightly, still well over 50,000 right now, and even the Nasdaq is having a much better day. It's up 0.84%. All right, those are the U.S. markets. We saw some of those numbers. The Dow hovering around 50. Traders, of course, awaiting this week's key jobs and inflation data. To talk more on how things are shaping up on Wall Street, we're joined by Adam Turnquist, Chief Technical Strategist at LPL Financial. Adam, thanks very much for joining us.
Hey, thanks, Roger. Great to be here.
Is this the start of the week that you expected after what we saw on Friday? I went away on vacation and I came back and I'm like, what happened last week? And today it seems a little calmer.
A little bit calmer, and as you mentioned earlier, it was a roller coaster last week, and unfortunately for the S&P, we did end on a high note. Same with the Dow clearing 50,000. I think this week maybe a little bit of calm before the storm, or a holding period until we go into Wednesday's employment data, and then of course Friday's inflation data. So we're hitting both ends of the dual mandate for the Fed. Pretty low bar after some of the economic data we had last week in the U.S. in terms of the labor market. Pretty underwhelming. So I do think that's the setup there. And then on the inflation side for Friday, we have had more of the commodity-linked inflation, we'll call it leading indicators, move higher, whether that's metals, whether that's crude oil. So that usually trickles down into the consumer inflation. I don't know if we'll get there yet, but I think a pretty low bar there in terms of inflation expectations and what the market might be able to absorb if it comes in a little hotter than expected.
And what kind of storms are you expecting for the numbers? I looked, you're saying maybe 2.5%, which is continuing to drop and get closer to that 2% goal.
Right. It's on the trajectory, and some of the metrics within the CPI report, notably the services side and the housing, that's really propped up the inflation at the consumer level. We see higher frequency data suggesting that that's going to come down, that owner's equivalent rent category. That should help. I think on the inflation battle, some of the other inflation metrics like trueflation have come down and deviated a little bit from some of the more traditional metrics. We think we'll get there, especially as the labor market slows down, but does not stop. We don't think there's a recession, just more of a slowdown. And I think that should overall help inflation come down as well.
And
Not to mention the productivity gains as well that we expect to see in 2026.
And what do you see the Fed doing with that 2.5% and heading into their next meeting?
So we think it's a second half story for the Fed in terms of when they'll start cutting rates again. We're pricing in maybe 2 more cuts this year, maybe 3, depending on how inflation moves in the next few months. But a good tailwind for the U.S. economy, U.S. equity markets. We've looked at how stocks handle rate cuts near record highs, and no surprise, it's been a pretty good tailwind for equity markets and more of a risk-on backdrop. And we expect that to continue, albeit not at the same linear path we've witnessed to this bull market. We think it's going to be a little bit more choppy, a little bit more volatile, especially with policy front and center here.
And with the Dow, we're talking about how it's crossed 50. Is that people pulling out of tech, out of AI, or do you see them coming back to it?
Out with the old, out with the new, and in with the old. I think in this old economy trade that's really propped up the Dow. It's been this broader rotation out of tech. It's not that tech is over or the big tech trade is over. It's really just been in this consolidation phase. I think as we've moved to the next phase of AI, and it's really a show me story in terms of quality of spending. What's the return on investment? Investors have moved to more value-oriented sectors, and that's really what's driving the Dow. So an important index, not necessarily the best benchmark when you look at the price weighting methodology there, but I think it does speak to just the overall trajectory and evolution of our equity market here and continuing higher. So a good sign for the bull market on a longer term view. Tech, we'll see how the sector shakes out this week. We had a nice rebound on Friday, especially in software. I think that's the swing factor here for the tech sector and the broader S&P 500 to get through maybe that 7,000 point milestone. That's been a little bit of a problem spot for the broader market here.
And with tech, what concerns do you feel there are? And then what are also some of the positives that you may see happening?
So the big concern is not just the AI bubble and the CapEx spending, it's the AI disruption. And that's been the narrative change over the last several weeks. That's played out most notably in the software space. A lot of these companies call it price for extinction when you look at the sell-offs. We haven't had this much downside momentum ever in some of the indices and momentum gauges that we follow. Probably a little bit overdone. And from our view, when you look at where valuations are, even when you look at overall revenue expectations, margin expectations within software, they're holding up pretty well. That valuation has reset to what we view as probably attractive levels down here when you're talking multi-decade low type valuations on an earnings multiple. So we think there's maybe some room for improvement. And that's one of the upsides that we see, just these oversold conditions creating maybe an opportunity, a little bit more of a asymmetric setup when we look at overall risk versus reward.
And then one of the forgotten or the beaten up ones, healthcare, but you're seeing some opportunities.
Right. We like healthcare. We're warming up to the idea of healthcare. It's been starting to outperform over the last few months, and we think it fits well into an overall portfolio because it does have a little bit of a defensive shift, but you also get some more risk-on type behavior, whether that's in the biotech space within healthcare. That's been working pretty well. Pharma, another one that has maybe some of the defensive qualities and provides a little bit of a ballast. And then AI as well going into the biotech space. When you look at some of the machine learning capabilities within the biotech space, they're bringing drugs to market cheaper and a much more cost-effective way and a quicker way as well. So that's another theme that we like within the healthcare space. Pretty good valuations and an earnings outlook as well.
Okay, we'll leave it there, Adam, but thanks as always for joining us.
All right, thanks, Roger. Appreciate it.
Adam Turnquist is Chief Technical Strategist at LPL Financial. Up next, Thailand's rise was once seen as unstoppable. Bloomberg Originals takes a closer look at what went wrong in this week's Short Doc after the break. Thailand's rise was once seen as unstoppable, but decades of political strife, inequality, and stalled growth have left it the cautionary tale of Southeast Asia. Bloomberg Originals takes a closer look in this week's Short Doc.
When I think of Thailand, I think of a place where modernity exists alongside tradition. But behind that postcard image of a paradise is another reality. Instability, volatility, uncertainty.
And in recent years, economic lethargy.
There's not a lot of innovation in the economy. Thailand's GDP growth has been about 2% for a while now, while neighboring countries or peer economies are growing rapidly.
Foreign investors have taken note, or more specifically, they've taken their money.
Thailand looking to cut rates as growth falters.
No catalyst for a reversal of Thailand's fortunes.
That word, fortunes, isn't relatable to almost anyone outside Thailand's entrenched elite. According to the World Bank, Thailand has the highest level of income inequality among Asia-Pacific countries.
What's at stake is Thailand risks getting left behind in one of the world's fastest growing regions.
So we're asking, what went wrong? And can anything be done to turn things around?
Welcome to the White Lotus in Thailand.
HBO's The White Lotus offered a high-profile glimpse of the experiences that make Thailand a draw for travelers.
Tourism accounts for about a fifth of its economy. Thailand is quite reliant on tourism, more so than its peers in the region.
Like those peers, the country's also a hub for manufacturing across multiple sectors.
Automobiles, agricultural products, food, and electronics. And it connects supply chain between China and the rest of Southeast Asia.
Those two economic engines, tourism and exports, drove Thailand's $570 billion economy in 2025, ranking it third in Southeast Asia. But those same engines are showing signs of strain. And the White Lotus, sadly, did not include a single chart about this.
Before COVID, Thailand was on track to reach 40 million foreign visitors a year. Then COVID hit, and tourism arrivals have never really gotten back to the numbers that we've seen before.
On the manufacturing side, geopolitics has also been a drag.
In 2025, the U.S. government imposing a raft of tariffs around the world, so this is upending trade, this is upending investment.
That's what you're seeing here, a measure of money flowing in and out of Thailand. Since 2023, investors have been mostly pulling money away, and by late 2025, the outflow reached a record high. Here's the thing, though. COVID and tariffs affected everyone. To understand what's uniquely throttling Thailand's growth in an otherwise flourishing region, we have to look back even further.
Thailand saw rapid growth and industrialization in the 1960s, and it transformed from an agrarian, low-income country to a manufacturing powerhouse. The 1990s was the golden era of the Thai economy.
Thailand was on track to escape poverty and become a rich country. The economy was expanding at such a rapid pace, 8% to 9% a year. People were spending, banks were lending, companies were hiring.
But financial institutions took on excessive risks, bad loans, and a great current account deficit.
And then, in 1997,
when the Asian financial crisis hit, speculators started attacking the baht, and the currency lost more than half of its value.
Banks failed, businesses went bankrupt almost overnight, millions lost jobs.
In the early 90s, Thailand's gross domestic product was growing at a healthy clip, around here. But the financial crisis left a deep scar, and growth has never returned to the same level. So why not?
In the wake of the 1997 financial crisis, Thailand elected Thaksin Shinawatra as its prime minister.
Thaksin's political rise is inseparable from his business success. As the founder of Thailand's largest mobile operator, he gained the wealth, visibility, and public profile that helped him connect with voters.
He became the country's most popular and also most polarizing politician in decades. Growth of the Thai economy picked up under Thaksin's administration.
But economic and political success made Thaksin powerful in the eyes of Thailand's old guard.
The establishment that's made up of senior bureaucrats, business elites, judges has controlled the country's most powerful institutions since the country became a constitutional monarchy in 1932. They did not want a strong elected government that would clash with its interests.
And that came to a boiling point in 2006.
Thaksin was toppled in a military coup that has led to a decades-long rivalry between Thaksin and the old guards.
Years of protests and leadership changes followed. And this consistent political upheaval is the first major contributor to Thailand's unique economic problem. Thailand has raced through prime ministers over the last 20 years. 5 of them from Thaksin's camp, who came to power through elections, have been ousted by court or by coup.
This is a tug of war between the establishment and the civilian government. They take turn governing the country, but at the same time, none of them stay long enough to really introduce any meaningful changes.
For decades, this has broadly been defined by a power struggle between pro-democracy advocates and the elite.
Since Thailand became a democracy, it already had 13 successful coups and about 20 versions of the constitution.
From an investor point of view, they want to have some certainty that the policies that are in place today will be surviving over the course of an investment. But when you have a revolving door of governments, you don't have that certainty.
Thailand's concentration of wealth at the top has created another unique bottleneck for the country.
One of the world's highest income inequalities.
In fact, its richest 10% controls nearly 70% of the nation's wealth. That's higher than any other country in the region, such as Indonesia, Malaysia, and Vietnam.
Bangkok and other economic corridors were booming while the rest of the country was engaged in low productivity agricultural practices.
The majority of corporate wealth in Thailand are in the hands of just a few hundred people. Rich billionaire family in Thailand control large conglomerates that dominate key sectors across the economy.
In Thailand, political access protects business interests while wealth gives you more political bargaining power. Often, when economic power and political authority sit within a small group of people, they resist changes to reduce monopoly, increase competitions, and redistribute wealth.
And increasingly, this is being passed on to ordinary families, already burdened by long-standing debt.
This is a legacy of the post-1997 crisis where credit was used to revive growth. But when wages stagnate and consumption is expected to rise, households borrow, and sometimes more than they can pay back.
At roughly 90% of GDP, Thai household debt is now among the highest in Asia, only scarcely below South Korea and Hong Kong. Now, when a huge chunk of a family's income goes toward interest payments, it's harder for them to spend on anything else, and that includes further education, bringing us neatly to the last stop on our tour of Thailand's unique economic bottlenecks: talent.
Thailand produces relatively fewer engineers, data scientists, and those high-skilled jobs than the rest of the Southeast Asian countries, and it also doesn't have the same level of English proficiency as other countries either.
This is holding Thailand back, while countries in Southeast Asia are racing to attract AI and semiconductor investment.
Thailand is sort of stuck in old technologies that is slowly losing momentum without having any new products to offer to sell the world.
And it's facing another issue with its workforce.
Thailand is aging faster than it is getting richer.
So About the middle of the 2010s, Thailand's working age population, the growth in that cohort started to slow dramatically. And then from about 2019, actually the workforce started to shrink.
And looking ahead, this decline is projected to keep accelerating for decades to come. If nothing changes by the 2030s and 2040s, the workforce could contract by around 1% each year. So today, Thailand is battling a perfect storm: stagnant growth, soaring debt, and a shrinking workforce, all against a backdrop of political instability and deep inequality. Its leaders are faced with solving a puzzle of debt and demographics in a world that won't wait for it to catch up. Policymakers say they're aware of the most urgent issues.
We have planned on upgrading productivity in Thailand, especially reskill and upskill of Thai people, promoting investment.
Yet, no matter who's in power, they'll have to contend with the same problem that's held the country back for decades.
There's not a lot of focus in building industries that could power the economy into the future. Political instability is a root cause for that, and unless there's a meaningful reform in the political system, in the power structure, Thailand is never really going anywhere.
Coming up, today's market movers with Bloomberg equities reporter Monique Molina. Okay, let's take a look at some of the market drivers for today. We're joined now by Bloomberg equities reporter Monique Molina. Monique, thanks as always for joining us. First up, Cleveland Cliffs falling off a cliff. Can we say that?
Yes, so Cleveland Cliffs, their shares are down more than 28% this morning. And this is because of the losses they reported in their fourth quarter earnings today. The adjusted EBITDA losses were wider than expected, and the revenue also missed. And that's what's really weighing on shares today. They're down the most since March 2020, so this is a big decline for the steelmaker. Analysts say that these losses were expected because we had seen a reduction in production and volumes in steel, particularly with some of the weakness in the auto sector production. So this doesn't come as a total shock, but it is still wider than they had been expecting. And some are hopeful that we are going to see some improvements going into the first quarter results and into the full year results for 2026, hoping that we'll see some more of those steel volumes come back. And also the company is working on a partnership with POSCO, which is a South Korean steelmaker, and that analysts are hoping will be signed in the first half of 2026, which could also provide a boost for the stock that's seen such a big hit today.
All right, and out on the ocean, Transocean buying Valaris.
Yes, so Transocean announced this morning that they are buying Valaris. They are both in the oil rig drilling and contracting space, and it's in an all-stock deal valued at $5.8 billion. We have seen Valaris shares just soar on this news. They have risen the most on record. They were up over 20% earlier, and we're also seeing Transocean shares rising a bit on this news as well. These two companies combining is going to make the largest offshore drilling contractor in the world by market cap. So this is a big deal for these two companies to come together, and there's some hope that then they'll be able to continue to see more growth as a result. And as part of the deal, the Valaris shareholders are going to get some Transocean shares.
Okay, and last up for me, shares rising there.
Yes, so Fermi, their shares are rising this morning after Citizens initiated the company with a market outperform rating. This company is in the electric grid and data center power space. And this is an area that's seen a lot of growth as we've seen more AI companies needing power to be able to run these data centers for their artificial intelligence models. And for Fermi, they've seen their stock take quite a hit since their IPO last year, and that's because they haven't been able to sign a contract yet for a power agreement for their data centers. But the analysts at Citizens are really hopeful that we're going to see the first contract signed in the first half of 2026, and that's really going to provide a boost for shares because this is something that investors have been looking for quite a while. So there's a lot of hope that that's going to provide some momentum. The company's also planning to have 5 gigawatts of power come online over the next 5 years, and analysts say that this is going to really allow the company to get more of the market share as more hyperscalers are looking for power. And with the company being located in Texas, that's also an area that has been a location of interest for a lot of these companies. So they say there's a lot of opportunities that will be coming ahead this year that will really be able to kind of deliver on some of the hopes that investors have had.
Okay, we'll wrap it up there. Monique, thank you as always. Bloomberg's Monique Molina. When we come back, we'll get more insight on Barrick Mining's plans to spin off its North American gold assets. That's next. Clothing retailer Eddie Bauer has filed for bankruptcy with plans to sell as many of its stores across Canada and the U.S. as possible and liquidate the rest. The bricks and mortar chain listed more than $1 billion in debt, and the move marks the third time the company has filed for bankruptcy. Eddie Bauer's e-commerce and wholesale operations, as well as its retail stores outside of North America, won't be affected by this wind down. Shares of Cleveland Cliffs plunging nearly 20% right now. The steel manufacturer reported lower fourth quarter revenue as well as profit than missed estimates. Cleveland Cliffs says 2025 was weighed down by weak production from the auto industry as well as a weak Canadian market. The steel company says things are improving for 2026 and the U.S. trade environment should set the stage for dramatically improved results. Eli Lilly is buying biotech company Orna Therapeutics. The deal worth about $2.4 billion U.S. in cash and is aimed at expanding Eli's pipeline beyond its popular obesity lineup. Orna is currently developing a new class of treatments for certain autoimmune diseases, and its technology allows patients' cells to generate therapies inside their bodies. Looking at the markets, the TSX well into a good little mini rally right now. It's up more than 1% to continue the good from Friday as it approaches 33,000 again south of the border. Similar situation, or it was. Okay, now we got the Dow off slightly, still above 50,000, but the S&P 500 nudging around that 7,000 mark, and the Nasdaq up by nearly a percentage point right now. Newmont wants Barrick Mining to improve operations before spinning off assets. We sat down with Dan Rohinton, portfolio manager at IA Global Asset Management, for more perspective.
Joint ventures and minority stakes can do that to friends, if you will. But the best way to think about what's going on is these are all in the context of the interest in gold and precious metals has been very, very, very strong, to say the least. And that remarks up assets. And then when you have safe jurisdiction assets like the assets here would be, this creates that extra urgency on the part of both parties to come to that solution. I would say Barrick has more likely than not the latitude to make these decisions on their own. And this isn't the first time that you've seen some of the seniors like Barrick spin off assets. I'm old enough to remember Barrick Africa where they spun off those assets. So there are times where you spin off your EM assets that come at big discounts. There are times when the safety premium is particularly high for durable assets in safe jurisdictions. I think that's what's really going on here, but I would expect some element of this to come through.
Yeah, so there's a 1 year for Barrick stock. Maybe we could put up a 5 year. According to my Bloomberg screen, actually over 5 years, Barrick has been marginally ahead in terms of return over Newmont, but a lot of that is recent gains in the shares.
Yeah, a lot of this is really the precious metals rally, the resiliency of that precious metals rally. And I think that's important when you're looking at miners, Andy, is it's not just that the metal is up. The metal has to stay up for the investor base, for these companies to come around to the idea that they'll realize these prices. So it's not like in oil and gas where you have hedges or anything like that. If memory serves, we're mostly spot exposed for the whole complex of these companies. But it really comes down to investors need to believe that gold can stay around 5,000, and then they start pricing that in and put that through to the profitability of these companies. So it takes time, which is why the lagged reaction does happen.
Would you be overweighting portfolios in gold right now, Dan?
I'm very cautiously along for the ride, and I'm quick to exit, would be how I'd put it.
Okay.
The reason I say that is when you think about the structure of what's going on, you have geopolitical tensions, you have weak US dollars, you have conversations about central bank independence. I can't think of a better precious metals environment than that, which also means if some of these things start stabilizing a bit, then there's potentially an air pocket down. Please look at silver for reference from a few weeks ago.
Let's have a look at a 1 year or even a 1 month for silver, because that was quite a ride up and well down from its highs.
Yeah, and one more thing to add on that, Andy, if I may, is when you look at what's going on, it's not just that there's real money investors coming in. We live in a very different market structure than years past, where high-frequency trading, leverage purchasing, trading bots are very active. So these types of big once-in-a-Six Sigma events that they're known, or Eight Sigma, just deeply unlikely events to happen statistically, they happen because the structure of the market is a lot more algorithmic than it was before. So price chasing can lead to big drops like that.
Because the algorithms, well, one model is they try to jump on a trend.
Exactly. That's right.
And then, of course...
And then when the trend changes...
They'll try to get off.
Exactly.
Yeah. Scramble among the robots. The Prime Minister of Japan winning a landslide victory. She has plans for massive spending. What's that mean for global markets? What does that mean for Canadian investors?
Yeah, and I think the gold and precious metals is really how, and energy as well, indirectly. That's how these global trends tend to impact the Canadian stock markets. But I'll speak to just what's been going on in Japan. Japan is going through a big change in its structure when it comes to how it handles geopolitics, the history of pacifism, being more hawkish towards China.
Yeah.
Along with this victory came the idea of a significantly greater military buildup in Japan. So that is very much on the cards now. So, and a lot more directly facing up to China in those contested areas. And on top of that, a domestic policy that's far more, call it fiscal stimulus oriented than generations past. So that creates an awkward tension with the Central Bank of Japan, along with how the actual fiscal environment in Japan proper is going to go. So a lot of what you talk about in the US, in terms of just what we're seeing spending-wise and the relationship with the Federal Reserve, just copy and paste that over to Japan, Andy, because I think that's increasingly where we're going. And that's why these conversations about precious metals that we just had, also, that's how it filters into the Canadian economy.
Sorry, give us that again. So a radical uncertainty over the direction of Japan?
And inflation, less focus on inflation, more fiscal stimulus. That's part of the reason why gold has been so aggressively bid as well.
Yeah.
So Japan is very significant as a capital pool because Japan was a big savings economy, huge export economy, which means you have a lot of dollars that you send back and flush into the global economy. You buy treasuries, you do foreign aid, things like that. All of that, when your local Japanese government bonds are going up in yield, those Japanese pension plans, those investment funds, don't need to go out to the world for 4% if you can get it right there in the JGB market. So that drains capital out of the system globally and brings it more locally. I know that's a lot of balance of payments, mumbo jumbo, but what I'm really trying to say is Japan has an outsized role in the global economy outside of just export. It's because the money, it's the world's banker in some ways too.
Yeah, and also people have borrowed traditionally in Japan at super low interest rates and bought houses, for example, in Eastern Europe.
Yeah, that was known as the JGB carry trade. Yeah. And that's kind of inverted now too.
What about the Fed? I know we go on and on about it, but is there one thing we should remember about the new guy there, Kevin Warsh?
Yeah, most likely the new guy by the looks of it.
Okay.
And the way
if he gets confirmed. Yeah, sorry.
Yeah, of course. And when I think about just the bugaboo that's being made a little bit about the 1951 Accord, stepping away from the separation of, call it church and state, which was the Treasury and the central bank, that era of independence post-World War II. I think Kevin Warsh, I would give a little bit of credit where credit is due. He's criticized that hasn't been the case for a while, and I think there's some truth to it. So if you go to any periods of crisis like 08, 09, if you look at Timothy Geithner, Hank Paulson, and Ben Bernanke, you'd be hard-pressed to tell that there was separation of church and state there.
There wasn't much daylight between them, I seem to remember. Yeah.
And if you take what happened actually with Silicon Valley Bank, Andy, the same dynamic. So I think the blurring of the lines between the Federal Reserve and the actual U.S. government proper itself, the Treasury Department,
isn't that interesting?
Is graying already. And I think this is just going to move further down that road. I'm not sure yet that that's a good thing or a bad thing. I'm inclined to say it's probably not great, but it's too early to say. And the continuum with which we started in 08, 09, through COVID, through the banking crisis to where we are today, I think you can draw a clear line from there.
Before we let you go, you are a long-time observer of the auto industry. And I was amazed. I actually had no idea that 3/4 of the cars made in Canada last year were made by those two Japanese manufacturers, Toyota and Honda. So we've already had, we have had a major retreat from the U.S. market by the U.S. automakers.
Yeah, and the way to think about automobiles as a whole is what's going on. And a lot of this is we don't actually invest in these companies, but growing up in Whitby, Oshawa, it's so close to home that you can't help but follow. The nature of the combustion engine, the nature of autonomous driving, all of those trends are really coming to a head where we sit today. So we are moving from a car ownership world to something that resembles a lot closer to Uber, a few AI models from now, where machine vision is good enough that a few hundred Waymos can already accommodate 10% of the traffic in a minor city in the United States. So just imagine playing that forward a few years.
Car ownership starts dropping.
Yeah, car ownership and the need to do so. It's just cheaper to get in an autonomous vehicle as we move forward. So I think these companies, they've taken, I'd call it the hybrid approach by doing hybrids. But the world of EVs plus autonomous driving, I think, is coming a lot closer to today.
And can Canada really be a player in the global auto market?
The tough part about that conversation is probably not, because we lack what's known as network effects in an industry, right? So there's a reason why Silicon Valley became what it was. It was Fairchild Semiconductor, then came some other firms, and then finally came the internet boom that led to where the modern Silicon Valley is today. So there's a continuum. China has invested hundreds and hundreds of billions of dollars in building a big, deep ecosystem of automotive. And it's at a scale where it's cheaper to export on a ship than it is to build locally.
And he was speaking with Dan Rohinton, portfolio manager at IA Global Asset Management. Coming up, Canada's plan to build national projects has been the talk of Ottawa. Next guest lays out how the country can go about that through evidence-based methods. With talk of major nation-building projects remaining top of mind for Prime Minister Mark Carney, a clear plan for what that entails is still in progress. However, researchers at the C.D. Howe Institute are attempting to answer that question, providing what they say is an evidence-based strategy to achieve that goal. For more on this, we're joined by David Jones, Senior Fellow at the C.D. Howe Institute. David, thank you very much for joining us.
Hi there, pleasure to be here.
Why do this? Why do you feel this is needed? What you've put together here?
So the desire to accelerate the building of projects in the national interests in Canada is clearly front and centre mind in Ottawa at the moment for the federal government and also the country, as you mentioned before. So what is set out in government legislation at the moment are a high-level set of criteria that the government will and can consider when thinking about which types of projects should be designated as a project in the national interest. Now, though those criteria, that set of criteria, is relatively high level, and in order to, for several reasons. Firstly, to ensure that there is proper transparency, that taxpayers can ensure value for money, but also to ensure that there is certainty and transparency again for the private sector and project proponents who are considering making significant investments. It's important to think about in practice what those criteria are really likely to mean. so that the federal government and the Major Projects Office, who is supporting them in thinking about these projects in the national interests, can have a proper evidence-based approach and to provide that certainty for taxpayers and project proponents, as I mentioned.
Do you not feel that they would be including something like this?
As in the federal government, you mean?
Yes, sorry, as in the federal government.
Yeah, sure. So, I mean, they have outlined some criteria, but at the moment they're just at a very high level. And whilst there is a benefit in having very high level criteria, that provides a lot of flexibility for the government, which could be useful moving into the future, for example, as different sectors or type of projects come along, artificial intelligence, data centers, etc. There is some benefit in flexibility. But if there is too much flexibility, then there isn't, it doesn't generate that certainty, particularly for private sector investors. So whether it's in transportation, energy, mining projects, ports, those investors really need the certainty about what the government is thinking in terms of when those proponents are thinking about the types of the projects, developing their business plans, spending potentially large amounts of money, doing impact assessments. So it's quite helpful to set out those criteria in more detail, and that's what we've tried to do in this research piece.
And what are some of the criteria you're using, and what were the end results? Which project kind of came out ahead?
Yeah, so we've building on the federal government's 5 criteria that they have in the Building Canada Act. We thought about those and we looked at a number of sub-criteria in detail. We think that the government's high-level criteria do provide quite a helpful framework. So that's thinking about economic security and resilience, economic growth, the likelihood of project delivery, the likelihood of advancing the interests of Indigenous people, and clean energy growth or alignment with climate goals. So what we did in the research piece is basically fleshed out those in a bit more detail. So, for example, thinking about the economic growth criteria as a high-level criteria that the government has set out, we broke that down into a little bit more detail. So we thought about what are some of the metrics that the government should be thinking about. So, it's things like economic growth, GDP, employment. What's the evidence that can be used to evaluate that project? So are there business cases? Are there projections of revenue? What's the additionality for the country as a whole? So is the government going to have to put in a lot of money to get a return, or actually is the private sector likely to be able to do this fairly independently? And just as a final example, the likely future-proofing of a particular project. So I think it was your last caller potentially discussing things like global commodity prices. So that is something that will need to be factored in potentially when you're considering a project that is in the national interest, because ideally projects would need to be viable, profitable. That reduces the amount of funding or support that the government needs to put in order to generate that investment from the private sector going forward.
So which projects came out on top, and what one finished at the bottom?
Great question. So there are, we should say what we've tried to do in the research piece is to focus on the methodology. So there were some data constraints that we faced in doing the research. So our results in terms of the sort of project rankings were fairly indicative. We only looked at a subset of projects or potential projects. But we did find that there are some projects or kind of sectors that seem to score quite well. So ports, for example, ports can be used in multiple different ways. Obviously, you've got imports and exports. If one sector is growing and another is diminishing, as long as the port has the proper infrastructure, then it would be able to kind of pivot to where demand is globally and to Canada's evolving trading partners and relationships.
Yep.
The projects that scored less well were those that were less developed as of now. So one of the government's criteria is to have is around the likelihood of successful execution of the project. So some of the projects that are, or kind of strategies that the government has talked about, things like investments in critical mining, as a kind of general strategy or in large areas rather than, say, very specific mining projects.
Okay.
Those kind of strategies tended to score not quite as well because there's less detailed information. The final one I'll say is there are certain projects that involve trade-offs as well, so those tended to score not quite as well.
I do have to cut you off there. I apologize, David, but we're out of time.
Sure.
But thank you very much for joining us.
Cool. Thanks very much.
David Jones is a senior fellow at the C.D. Howe Institute. Coming up, we'll take one last look at the markets before we go. All right, let's take a quick look at the markets before we go. First up on Bay Street. After an up and down week that finished with a bang, it's continuing that upward surge for the TSX, getting close to 33,000 again. Still, the record territory will be almost at 33,100. The S&P 500 has dipped back below. It was above, closing in on 7,000, and it's up as well. And you can see the NASDAQ as well, taking off right now, up by 1.1%. All of them after that good Friday they had last week. And Market Call is coming up next. Joining us is Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. His focus, North American equities. Thanks for watching Morning Markets. We'll see you tomorrow.